The European Central Bank is undertaking a really unprecedented investigation into the Eurozone's financial system as a prelude to the job of taking over as the head of the single supervisory mechanism, effectively a brand new super regulator for the Eurozone financial system under the auspices of the ECB in Frankfurt. As I said, this AQR is an extraordinary piece of work involving analysing the assets of nearly 130 banks and other financial institutions around the Eurozone, followed by a stress test of those institutions' balance sheets to ensure that they can withstand an unpleasant deterioration in economic conditions. And what we've had today is a lot more detail about how that AQR, asset quality review and stress test, will be undertaken, looking at banks ranging from Deutsche Bank to Societe Generale to UniCredit. What we've received today also from the European Central Bank is confirmation of the stress hurdles that the banks will have to withstand as part of the stress test, which is running alongside this AQR process. There are two main hurdle rates that the banks have to live up to. In a baseline scenario under the stress test, they will have to show they have 8% common equity tier 1 capital, even when there's a deterioration in economic conditions. And then what the ECB calls an adverse scenario, where there's a really profound deterioration in conditions, the banks will still have to prove they have 5.5% CET1 capital. Now, what happens if either of those two hurdles are not met? The banks will clearly have to raise more capital and prove that they're really up to the task of being continuing enterprises if there's a nasty turn for the worse in the European economy. Well, what's at stake here is what's hoped to be, in European policy-making circles, a once-and-for-all solution to a problem that has dogged the European economy for many years, which is the unresolved weakness in the European banks' balance sheet. The hope is that by forcing banks to come to terms with their losses, the ECB will have a far healthier banking system when it takes over supervision in November. In a sense, if you look at it from the point of view of the European Central Bank itself, this is its last chance before taking over responsibility as a supervisor itself to blame national supervisors for the problems in the bank. From here on in, any new problems that come to light will effectively be the ECB's problem to deal with, which puts it in quite a tricky position given the national sensitivities around individual banks.